In this recording, we're going to look at another new standard called IAS 10. This standard deals with what happens events after the reporting period. So after the year ends, something happens, either a major issue or maybe a minor issue, and how do you decide whether or not you need to disclose that or account for it in the financial statements that have just passed. So we need some clear and consistent rules, which is where IAS 10 came out of. So when you're preparing financial statements, you must give regard to all the available information. So if you have a year end 31st December, well, naturally enough, between the time lag, there's going to be a number of weeks before those financial statements are finished. So it might be January, February of the following year. So how do you account for items that occur after the year end, but before those financial statements are finished and finalized and analyzed? What can you do? Right, so IAS 10 defines what an adjusting event is and also what a non-adjusting event is. So financial statements, again, we know they're usually prepared at a particular period, usually a year end, but they will be published in as soon as possible after the year end. But you have to think of a timeline, and we're going to look at one now for Glanbia. Do I have to do year-end adjustments? You have to deal with accruals, prepayments, do a closing inventory stock take. The accounts have to be audited. So there's a whole process to go through after the year end in terms of inputting the information, auditing it, getting the approval from the board, signing off on it, and publication. And that even for the biggest companies in Ireland or the world, like listed companies, where getting access to relevant information in a timely manner, it can still take the guts of 8 weeks, if not longer. And to give you an example of that, let's look at Glanbia, the annual report that you have up there. Its year end was the 4th of January 2020. The financial statements weren't approved until 2 months later, essentially, at the end of February. The audit report was signed off on the same date, and the results were published the next day, the 26th of February. The annual report then was published about 2 weeks later on the 9th of March. So the real time period that IAS 10 deals with is once the year end is finished, until you actually sign off and issue those financial statements. That's the time period we're looking at, those events after the reporting period. And we need to figure out, does that event require us adjusting the accounts for the year end January 2020, or does it require just a disclosure to say that this is a material event after the year end? And they're the rules IAS 10 gives us. So it's quite important because that's still 2 months, it's 1/6 of a year. So a lot of things can happen there that if you ignore them, the users of financial statements are not going to get the full picture when they're reading the 2020 or the year end, well, this is probably 2019 majority of the accounts for Glanbia. So that usual time delay, that's the key thing we're looking at. So during that time, more information becomes available, and also events may occur which affect items in the financial statements. Assets could be impaired, assets might be destroyed, right? There could be court cases. So we need to get some idea of what's the consistent way of going about this. So the accounting question here is, do we adjust the financial statements, say the 2019 financial statements, for something that happens in January 2020? Or should we just disclose it and let the user of the financial statements at least be aware of what happens? And how do you decide whether something needs adjusting or whether something just needs disclosing? And that definitions are hugely important. And it's very easy examine an IAS 10 question as part of a bigger IAS 1. It could be just one note as part of a bigger question. So what are events after the reporting period then? So there are events both favourable and unfavourable. So it's not just looking at negative events, you can look at positive events as well, that occur between the reporting date, which is the 4th of January 2020 for Glanbia, and the date when the financial statements are authorised for issue, which was the 25th of February 2020. So anything that happens within those two dates is within the scope of IAS 10. Anything that happens after the financial statements are authorised for issue, so maybe the 1st or 2nd of March, that's outside the scope of IAS 10, that's for next year's accounts. Anything that happens before the reporting period date, that's just a normal transaction. Within the reporting year, you do as normal. So the only thing we're looking for is dates or events that happen between those two dates, when the year end finishes and just before the financial statements are finalised. Now what you want to watch for here is the financial statement, the date the financial statements are issued for approved by the directors will be in the director's report. So if we take, for example, you can take CRH, we have Kerry Group as well. So just go back to page 1. We look at the, where's the director's report? So you see government's director's report here. So we look at page 102. They're usually in the financial statements as well. So 102 is the director's report. We look at the consolidated financial statements first. You come down here, consolidated income statement. So they usually say it at the end of the financial statements. Not always, but sometimes they do. They don't give a date there. So we go back up and we look at page 102, which is the director's report. So you see the director's report, it said the year end, 31st December 2019. And when you come down to the very end of the director's report, they usually have a date in it. So come down at the very bottom where they sign off, the 27th of February. See the way they sign off the director's report? That's the date they're authorized for issue, 27th of February 2020. So if you even look for that, you can see the actual auditor's report. So chairman, date 27th of February, chief executive 27th of February, and if you come back there, the audit report as well. So everyone signs the 27th of February. That's the key date, which is the date that the financial statements were authorized for issue. So you can always get a look at that. The year end was 31st December 2019, but 27th of February is the key date when they finish off, they close off the financial statements. And it's also there, you can see Pat O'Neill, who's the auditor from EY, he signs his audit report off on the same date. So that's kind of seen as the closure date for CRH. Kerry Group, you can see a similar one. If you come to their director's report, you go to the end of the director's report, we see here, it was the 17th of February. So a bit earlier, maybe 10 days earlier, but there's still a good 6 weeks of finalising those financial statements and getting them audited. So if you control F, the 17th of February, you'll see the auditor signs off on the same date. Just easy to go down like that. And see the auditor here for Kerry Group was John McDonnell from PwC. He signed off on the same date, 17th of February. So that's kind of seen as a closure date where everything for that particular year is finished off. And so from the year end to that end of February, that's where IAS 10 comes into play, events after the reporting period. So you have two types of event in IAS 10. You have the adjusting event, and this is important. Adjusting event, as the name suggests, means this event is going to have to be adjusted in the financial statements. So even though the event happened after the year end, importantly, it gives additional evidence of conditions that existed at the year end. So that's the key thing here. Something happens after the year end. You sell an asset, you settle a court case, but that gives you more information about a condition that already existed at the 31st of December. So it suggests the asset was impaired or the court case would be settled for this. So that's a tricky one. It happened in January or February, but you're going to adjust the year end, the previous year end's accounts. The other thing that it's an adjusting event is if something happened after the year end, which brings into question the going concern. So remember, going concern is a key assumption, the ability to continue for the next 12 months. And a lot of companies are looking at this now with regards to COVID. Maybe you will have to question the going concern and the auditor will be looking at it in quite a lot of detail as well. They're adjusting events. The non-adjusting events, this is something that happened after the year end, but the condition did not exist at the year end. So it's a brand new event. It's not linked to anything that was in existence at the year end. Now that definition can be tricky, but the easiest way to look at it is we'll look at some examples, because the more examples you look at here, the more sense you'll make of the distinction between adjusting and non-adjusting. So the accounting for an adjusting event, that is a journal entry is posted. It has an impact on the accounts, even though information happened after the year end. The information relates to something that was there at the year end. So you make a journal adjustment in the year end 2019. So even if it happened in 2020, or happened, for example, in 2021, you'd adjust the previous year's accounts because it's extra information about a condition that already existed. So let's get an example of an adjusting event. For example, a settlement of court case. The settlement might happen in January or February 2021, but that court case was already active in 2020 and it relates to issues that happened in 2020. So that means it's just giving you additional information of a situation, i.e. the court case, that was already in existence at the year end. So what you can use, you can use the settlement of that court case to update your provision. Remember we covered provisions this week as well in IAS 37. So you should adjust any existing provision or create a new one based on this additional information. Even though that additional information came after the year end, that's IAS 10 allows you to do that. This is an adjusting event. Now, if that court case relates to 2021 and it was settled in 2021, it's not an adjusting event because it doesn't relate to conditions that existed at the reporting period end. That's the key thing here. If the court case was active in 2020 and then you get new information in 2021 that tells you what the settlement is, that's an adjusting event. But if the court case was only initiated and was only really related to 2021 events, then it's outside the scope of IAS 10. It's a non-adjusting because there was no conditions existed at the reporting period end. Same with evidence of impairment of assets. So for example, if you sold sales on credit to a customer, the customer was fine at the year end, but a month later they go bankrupt, then you'll write off the bad debt at the year end because essentially it's giving you more information about what that customer's creditworthiness was at the year end. Likewise, if you sell inventory at a lower price, maybe the middle of January, that'll give you evidence that maybe you need to write it down at the year end. So evidence of impairment can be used as well, particularly in terms of bad debts, which happen after the year end, but relate to assets that were there at the 31st of December. So there's a lot of little things like that you need to watch for. Assets sold or purchased before the year end. So you might have a transaction where you buy or sell assets before the 31st of December, but the price is only decided after the year end. That will be an adjusting event. Likewise, if you have a profit sharing or bonus arrangement with your staff, but you don't really know what the bonus will be, it might be a percentage of profits until you determine the profits after the year end and all the year end adjustments are done, that's an adjusting event as well because you have a legal obligation at the year end to pay that profit or bonus scheme. So all of those are adjusting events, that there's a condition that existed at the year end, but you get more information after the year end. Discovery of fraud. So if you identify fraud or errors that you say, hold on, that fraud or error was in existence at the year end, we need to adjust the accounts. Or anything that calls into question the company's ability to continue as a going concern. So what we mean by that is if you identify anything that happens after the year end, it could be COVID, it could be a big fire that wipes out a lot of the business, not just a small fire, but a fire that destroys a lot of the business, questions whether the business can continue, then that could be an adjusting event and you change from the going concern basis to maybe an accrual or breakup basis, should I say, where the company is not going to continue for 12 months in the future. So let's look at a small example then. Aon Limited prepared its financial statements to the year end 31st December 2019. And at that date, it was owed $20,000 by a customer. So it was in trade receivables. The financial statements were approved for issue the 25th of February. On the 10th of January, 10 days after the year end, this customer was declared bankrupt and is expected only to be able to pay 15 cents on the euro, or 15%. So you're only going to receive 3,000. You're going to write off 85%, which is 17,000. Now the question is, should that be written off in 2020 or should it be written off in 2019 accounts? So the logic here in IAS 10 is that this is an adjusting event. Now it's seen as an adjusting event because Flip owed the money at the year end. This is giving you more information that this customer was probably bankrupt 10 days before that as well. So it's giving you more information about the true realizable value of this trade receivable. So if I would expect you in an exam scenario, if this came up, what you'd be writing there is IAS 10 adjusting event. Because you don't have to write an essay to explain why it's an adjusting event. The money was owed at the year end. So this condition did exist at the year end. You will write off 85%. That's where a lot of students get caught. They will only write off 15%. They're only receiving 15 cents. So you're going to write off debit bad debt expense, credit trade receivables, 17,000. All right. And you'll debit the expenses. Now that's because the money was owed at the year end. If that sale took place in January 2020 after the year end and then was declared bankrupt, that's not an adjusting event because the condition, the money, was not owed at the year end. Same logic for inventory as well. If you have inventory at the year end and then it's sold at a deep discount after the year end, that's again evidence of impairment of the asset at the year end. So just watch for those little ones about the dates, and remember IAS 10 is a key thing. Once the year end finishes, IAS 10 comes into play. So you will write off 85% and you will leave the remaining 15 cents, the 3,000 there. When it's going to be paid, you'll receive that money and that will go into the 2020 accounts. That's a tricky one. It's a new dynamic now. We're dealing with a period after the year end, not just the 12 months of the financial statements. Non-adjusting events, they're a bit easier, no adjustment. They do require disclosure, however. So you'd explain the nature of the event, estimate the financial effects if you can, and where it's not, disclose why you cannot estimate the financial effects. So the key thing is here, there's no debits and credits. When we mean no adjusting, we mean we don't put through journal entries, but you're still going to disclose them if they're material on the face of the financial statements. So i.e. in one of the notes, should I say. So the notes of the financial statements. Example here, decline in the market value of investments. So yes, we know you might have those investments at the year end, but by their very nature, they're going to go up and down each time. Right? So they're going to go up and down. So that's not in itself an adjusting event. That's just the nature of those. Acquisition or disposal of businesses, if they happen after the year end, that's a non-adjusting event. You discontinue an operation or close a factory, plant, etc. You might do a reconstruction of a business or restructuring a business, or a major issue of shares or a major drawdown of a new loan, which is a debenture. None of those are adjusting events. All of those, they are merely disclosing them in the notes of the financial statements, but you will not make journal adjustments. So there's a key distinction there. Right? Other ones, major purchase or sale of assets, destruction of major production plant by fire after the reporting period. Now that's assuming this fire doesn't bring into question the going concern. If it brings into question the going concern, then you're an adjusting event because that's a much more fundamental issue to the accounts. But if it's just a destruction of one plant, it is bad news, but of course it doesn't impact the ability of the company to run overall, then it's a non-adjusting. Any large changes in prices or FX rates, or any changes in the tax rates or tax laws. So none of those are conditions that existed at the year end that warrant an adjustment being made. They're all non-adjusting events. And your answer to there, if that was asked an exam question, would be, as you'll see in the next example, no adjustment is required. And you have to use the language, it's a non-adjusting event. Disclosure is required instead. So just to be able to articulate and reference IAS 10. So for example here, Walker prepares the financial statements to 31st of March each year. Financial statements were approved for issue on the 10th of June. That's your period between the 1st of April and the 10th of June. In that period, a hurricane damaged a number of motor vehicles and the cost of financial effect, 20,000. The profit for the year in March was 1.2 million. Now the first key thing here is this is a non-adjusting event. Right, the motor vehicles were damaged after the year end. You might think, well, hold on, surely that's a condition that existed at the year end, but this is a clear example of a damage to an asset after the year end, in terms of destruction of whatever by fire or damage like that. That's different than the impairment of an asset it's different than the write-down of a bad debt or the write-off of inventory, and it's explicitly dealt with. This is not something that happens day to day. This is a one-off hurricane damage. So in that case, this is a non-adjusting event. The key point here is then, do we need to disclose it or not? Because the idea of non-adjusting event is required disclosure is only needed, and this is why you want to put in here in the benefit of come to class and listen to the lectures. It's only required when it's material. So for example here, these are only 20 grand. The reason you are given this line is to show you that that 20 grand is a very small portion of the overall profit. 20,000 over 1.2 million is 1%. Now, usually to say it's material, it's been higher than 5% or more. So in this case, the full correct answer would be, this is a non-adjusting event. However, under IAS 10, disclosure is not required as the financial effect, 20,000, is not material. And that comes from paragraph 21 in the standard. I don't expect you to be able to reference the exact paragraph, but I expect you to have an appreciation. You only disclose non-adjusting events when they are material. Material is probably going to be an impact of greater than 5% of assets or 5% of the profit for the year. In this case, it wasn't material because it was a very small impact compared to the overall profitability. Now, of course, you can still voluntarily disclose it if you wish, but you don't have to because it's a smaller impact. The other key thing that's covered in IAS 10 is dividends. When to recognize dividends and how to recognize them. So dividends on equity instruments, likes of shares or preference shares, fall into three categories. Dividends that have been declared and paid in the current period, interim dividends that have been declared but unpaid, so they're owed at the year end, and final dividends that have been proposed but not declared. So that language is quite important here, the difference between declared and the difference to proposed, because that hinges on how you account for it in IAS 10. So let's look at the first scenario, dividends that have been declared and paid. So the fact that they've already been declared, which is another word for approved, and that they've already been paid, they're in the financial statements in that period. You're recognizing that period. You'll debit dividends, credit bank. Remember, dividends do not go into the P&L. They go into the statement of changes in equity line, and they have the column is under retained earnings. They have their own line item. Any dividends declared after the reporting period, which means dividends that have been approved after the reporting period. Declared and approved are the same thing. That they've been approved by the board and shareholders at the AGM are not recognised as a liability. So if they're only approved after the year end, they're not a liability at the year end. That's a key rule in IAS 10. The only dividends that can be recognised as a liability at the year end are those dividends that have been approved, or i.e. declared, prior to year end. Interim dividends, so example, dividends paid halfway during the year, if these are declared by the directors but unpaid at the year end, they're a liability. Because again, the directors don't have a right to cancel them. So what does declared mean? It means appropriately authorized, which means it's approved. So watch for that language in the question. You're always thinking, have these dividends been approved prior to the year end? If they have, recognize them, either out of bank if they're paid, or in a liability if they're unpaid. If they haven't been approved by the year end, then they're not allowed to be recognized. They will be disclosed only in the financial statements. The final dividend, if they're only proposed by the directors, but subject to approval or declaration at AGM, they're not a liability. You're not allowed to recognize them. So a proposal is not final. You can propose a dividend, but it has to be declared and approved at the AGM. And it's that declaration and approval, and when that date happens, is the key driver for the recognition of dividends. So whenever you see dividends and information, the guiding one is IAS 10 as well. IAS 10 deals with events after the reporting period, and it also gives the key rules around the recognition of dividend at the year end. So let's give a little example, and we'll talk through each of these to see which ones should be recognized, which ones shouldn't. So we're looking here, the reporting year end in all three scenarios is the end of 2019, 31st of December. The first scenario is the dividend is proposed in November and it's approved in December, but it's not paid until January. Right? Well, in scenario one, we call it S1, that is allowed to be recognized because it has been approved prior to year end. Even though it's not paid till after year end, it's just a liability at year end. You want to debit dividends, credit dividend payable. So that's what's going to be recognized at the year end. It is allowed to be adjusted for because it has been approved prior to the year end. In this scenario, the dividends proposed before the year end, but not approved until after the year end. Proposal is not the key date, it is this date. Because this has not been, and be careful here, this has not been approved before the year end, some will say, well, hold on, it does sit in between the IAS 10. So for example, 31st December is the year end, the payment date is the 1st of Feb. What happens if it happens around IAS 10 period? That's irrelevant. The key date for the dividends is not the financial statement date of issue, it is the approval date. If that approval date happens after the year end, scenario 2 will be disclose only. You're not allowed to recognize those after the year end. Right? That is coming from IAS 10, paragraph 12, and paragraph 13. Right? You don't need to know the exact paragraphs, but there is specific things that deal with it. Same logic for scenario 3. It's not even proposed until after the year end and approved after the year end. So nothing happened in 2019. Again, that is after the year end. Right? So in this case, you will disclose it under IAS 10 as well. So if the approval date happens in that IAS 10 period, you can still disclose it in the notes of the financial statements. So your key rule is quite a straightforward one in IAS 10 for dividends. If it's approved before the year end, recognize it. If it's not, disclose it in the notes of the financial statements. And we'll see one or two examples of those disclosures now when we're going to look at CRH and Kerry Group. So if I look at Kerry Group initially, and we'll come back, we'll look at maybe 70, we're looking for the note. We're looking for notes in the 30s, usually one of the last notes, events after the reporting period. So we see it here. They call it events after the balance sheet date. Since the financial year end, the group has proposed a final dividend of 55 cents. You notice there it hasn't even been approved yet. It's only been proposed because the AGM may not have happened yet to be approved. And there's no other significant events outside the ordinary course of business. So you have to disclose that to make sure that you've said you've looked at everything else and nothing else is unusual. CRH have another example of events after the reporting period. If we come out back here, they have, again, it's a note in the high 30s. I think they're note 35, events after the balance sheet date. From the 1st of January, the key event that they had is they changed the reporting currency from euro to US dollar. So that's to say their main event after the balance sheet date. So every annual report will usually have something like that to say, were there any events after the balance sheet date? That's all covered in IAS 10. The model financial statements also has it as well. See the way it references there, IAS 10, note 21, which is the paragraph 21. You ever see the dot is the paragraph. So on this date, the premises were seriously damaged by fire and insurance claims have been put in, but there is a cost to the refurbishment that will exceed it. So they explain what happened. It was a fire. They explain the financial consequences as well, that the insurance claims will cover some of it, but the cost of the refurbishment will exceed it by a certain amount. So the key part of the disclosure is you disclose the nature of the event and you disclose the financial consequences if you can. Sometimes you won't be able to disclose the financial consequences because it's not sure yet or you're just estimating, but you still have to give an idea to the users if at all possible. In some cases, it might relate to a legal case. In that case, you won't disclose the financial consequences if it's prejudicial to the actual court case itself. So the date of approval, you have to disclose those in the financial statements, and we've seen that in Glanbia and CRH. It's usually the same date that everyone signs off, the auditor report, the director's report, the chairman's report, and you'll see it right throughout the annual report. So it's usually, even for big PLC companies, you're talking 6 to 8 week turnaround. So there's quite a delay in that information because it has to be audited, it has to be checked, it has to be published and formatted into a particular way, and all of that takes time. The other key thing we've referenced in other times is IAS 1 requires the entity to prepare financial statements on the going concern basis, which is that you expect the company to continue for the next 12 months. However, if the going concern comes into question because of information after the year end, you have to disclose it, right? So that's a key issue in IAS 10. If something material happens, a big thing happens, COVID, or you lose a big customer after the year end, and if that calls into question the going concern, that's an adjusting event. And IAS 1 requires the disclosure of when accounts are not prepared on the going concern basis. It's very rare, but it's something that has to be considered at least, and particularly for auditors now. When we've had financial collapses of Carillion in the UK, Patisserie Valerie, Ted Baker, where they've been recently signed off as being okay from the going concern basis, it's very much in focus for auditors to audit going concern, and for the directors to make sure that they're comfortable that the going concern basis is valid. And if something happens after the year end, which calls into question, then IAS 10 comes into play as well. So your disclosures, we said there, for non-adjusting events, if it's material, you must disclose the nature of the event and an estimate of the financial effect if you can. So it's just explaining what it is and the financial consequences. And you must disclose the date when the financial statements were authorized for issue. And you will see that in each of the annual reports that I've given you, including the model financial statements. So the differences between IAS 10 and the relevant UK and Irish GAAP is the same treatment, right? There may be one or two smaller extra disclosures in IAS 10, but I said for your perspective, overall they're quite similar. It might be quite less detail in it, but if I'm even looking at the IAS 10 standard that I have in front of me here, it's 1, 2, 3, 4, 5, 6. It's about 7, 8 pages long. So it's not one of the longer standards. It only has 24 paragraphs. So it's quite small when you look at some other ones which could have 100 paragraphs in a standard. So it's not one of the bigger ones, but again, it is important because it's a catch-all standard that happens for those 2 to 3 months after the year end. So in terms of your next steps, again, my first preference always would be the Margaret Darcy textbook. I think chapter 23 there, it covers in a nice bit of detail, looking at IAS 10 and giving you some nice examples as well. There is a question pack, which is also including IAS 37 and IAS 8. And if anyone ever wants to go and look at a summary of the standard, these are always useful links. They're not mandatory reading, but if you come here, you copy it in, you will get a summary of IAS 10, the IAS Plus. This is from the actual standards. Deloitte just sponsored them. It tells you when it came in. It actually came in back in 1978. So see how long ago that was? Effective 1980. So over 40 years at this stage. And it's merely been updated since then. So it's been different drafts. There's been a revised version, another effective date 2005. So there's been revised 2003 as well. But it's a fundamental one right since we had the very start. That's because it's one of the earliest ones, IAS 10. It was a key standard. And it gives you the key definitions, gives you the key accountings, and it just summarizes them. So it summarizes the standard and what you need to know. And what I like about that is if you come back, you can see it references the paragraph as well. 10.3 is the third paragraph in IAS 10. And if you want any additional information, you can get an e-learning, or you can get more, particularly in terms of COVID, that's an interesting one, events after the reporting period, where it's a video that discusses the impact of, well, if your end was 31st of December 2019 and COVID happened in February, March, you mightn't have signed off your accounts. What are you going to do in terms of disclosures? So it's quite a practical, even for this year now, year end 31st of December 2020, and you're now having issues in terms of lockdown again and the impact on your business, that may cause going concern issues for some businesses. So those IAS plus links are very useful just to summarize the key things you need to know and even see where this standard came from. And there's always additional learning resources that are available that can complement the textbook and complement the material you have from class as well. All right. So this recording looked at IAS 10, events after the reporting period.